How's it going, everybody? Good morning, afternoon, evening, depending on where you're at. Welcome to the 912 Financial Group Playbook Review. We're going to be going over the February 2023 issue 2B. Uh, really trying to get after, obviously, keeping up with the trader trend reviews going forward. And for anybody new to watching these, what we do, kind of a template for these, is we go through the market expectations read, and then we look at all of the trader trend um, uh, recommendations. And those trader trend recommendations are all going to be typically options that are expiring the next month. Um, and they're a little bit shorter term. And we go over, kind of see how we did, and review there, try to help and answer any questions. As always, give us a follow on Twitter for the most up-to-date information on these things. And please, everybody, really try to help us to expand the community. Tell your friends or people online or people learning how to trade options about what we do. And as always, all commentary, criticism, good, bad, indifferent is welcome. So, feel free to make comments on either on YouTube or on Twitter itself. Links will be in the description for the Twitter pages there. So moving on, let's see how we did in the mid-issue of February for the trader trend. So the market expectations for mid-February, still a crapshoot, still in a range, the same range we talked about in the last edition, from 3,500 to 4,200. Can't really go up because of inflation and higher rates. Can't really go down because of a new round of company buybacks and the belief that the worst of the inflation rate cycle hikes are behind us. Again, the folks that simply took our advice of going for the investor trend suggestions, where the suggestion was neutral, the strikes of the short puts are far enough out of the money to give you either a great accumulation level or money in your pocket, and they continue grabbing a featured investor suggestions for the same reason, like a great accumulation level or it runs to target for minimal cost. Did great. And if you're stuck with only adding trader trend naked put sales when suggested, not the aggressive trader trend bullish vertical spreads, you're on average also very happy. But again, we're still in a range. And though some of the major indexes have moved into macro uptrends, they did so in an unconvincing manner. We could break back below or test the top of the range. It will only take a couple of words from the Fed or a couple of economic reports to make it move. Anyone that says they know what those will be is kidding themselves. Both cases for the next leg are equally convincing. The bear case that we still have very high inflation, earnings are lower, tech is still laying off a lot of people, home prices are still falling, food prices are still rising. Have you seen the price of eggs? And further expected rate hikes from the Fed. For the bull case, we had everything. We had that everything was bearish. Layoffs, falling housing prices, poor earnings. That's exactly what the Fed wants. Bad news assures the Fed that its rate cycle hike is working, and they can sit back and let rate hikes work through the economy, evidenced by the fact that the last hike was only 25 basis points. And future hikes are expected to be in the 25 basis point increments. Odds are the next leg will be triggered by outside events and temporary. As for commodities, the days of king dollar may be behind us, but it isn't going to zero. The range is in. That said, that's why in the last edition we revised our commodity outlook to also expect a range. The highs are in, now we have to establish the lows. As for bonds, yep, you guessed it, a range. No upside, but the bottom must be in place. There's just nothing remarkable going on in that space either, so stay wide with investor trend suggestions there too. That's life in the range, folks. Stay wide never stops it and collect time decay. So again, we really recommend to follow the market expectations. Now, the uh, the trader trend suggestions, right, are all going to be shorter term, a little bit more aggressive with short call sales and um, a little bit tighter stops, kind of more for actively the active trader, whereas the investor trend is mostly going to be staying wide. So, we recommend to really read through, stay with it. But if you don't, and you just want to stay with the trader trend, mechanically it is sound, and over time plays out to be profitable. If you look back through the last 6 years uh, of 912 and previously LCR recommendations, they do work out. So going through them, and this one, just going to tell you guys, there was a lot of stops on the trader trend here. So the recommendation really was smart, and hopefully everybody kind of did that. If not, This is one of the times that it was good to that potentially your hedges came through. Now, when I talk about hedging off risk, there's a few ways to do it. And we had a lot of gap risk with these things going on in the range. Ranges do whip around. We get some extended days both ways. Now, there's a couple ways to do it. Typically, what is recommended, and I'll go over this more in future issues or even make a separate video about it that I'll put up through Twitter. But put back spreads are going to be the cheapest insurance you can do. And for anybody who doesn't know what a put back spread is, basically it's a trade where you would sell a at the money um, put option and use that to pay for some out of the money uh, long put options. And it ends up being pretty much for free if you can get them. You could do it pretty wide, go maybe 2 or 3% or 5%. Um, out on the long units, and that'll give you maybe even a 10 to 1, 10 long units to one short unit, or a 5 to 1. And if the trade doesn't go your way, right, if it doesn't drop down on those, then you'll end up just owing the credit if the trade closes above the short put strike. So that's a really good way. It's very, very inexpensive. You might actually even collect a credit for it if the trend keeps going up. But is a great way to hedge, especially if we are really in a kind of a rangy, choppy market with extended days here and there, or even if we're trying to buy and the market just tends to fall out. It's a good way to do it. The other way to do it, and that'll help protect against gap risk and things, but the really good way to protect against gap risk is to have a futures account. Said it over and over again in the past. A futures account can help you to hedge off your risk overnight. It's amazing what really buying or selling uh, an ES contract will do when there's some momentum and London's selling off big or something, and you sell a ES contract, you can really hedge off a lot of that gap risk the next day. So we'll go more into that. This is one of the times that it definitely would have played out. So 99% of the time, those back spreads are going to go out. Um, worthless, but periodically they really do pay off, and that's when you're thankful you put them on and spent those commissions. Okay, so going forward, just into what we're doing here. The first suggestion was CVS or CVX, so Chevron. The trader trend recommendation was to sell the 175 naked call with a stop at 178.35. And so with this one, where's the here we go. So CVX was here, and if you sold that 175 make a call, you got 85 cents for it, and you would have sold it back here. So you would have got 85 cents for it, and then price clearly didn't go up to 178.35. So if you had a bid back those short calls, you would have took it $80 for it. All right, so that one worked out. The next one going to HYG, the trader trend for aggressive traders. Now, again, we always say too that there's a great, and you have to make this decision, but aggressive and conservative, right? So if you're conservative, you're maintaining a cash position, just putting on nothing. If you're aggressive, you were selling that March 76 naked call with a stop at 75.15. Um, the results always do vary on this a little bit, guys, and depending on kind of trader you are, you're going to be taking that risk. And so, going through, testing it, really defining your risk parameters and what kind of trader you are, really make sure all that's in your trading plan before you go out and do this stuff. So, if you had have sold the March 76 naked call for HYG, you would have gotten about 15 cents on that, and you would have got it back for price never actually stopped out. We can go check HYG. And we'll tear through these pretty quick. Like I said, a lot of stop outs on this issue, so we're not going to spend a ton of time going through this stuff. But this one, yeah, you see, you would have sold it back here. Price obviously never came to 76, and so you would have gotten $10 back if you had to bid back those units for a nickel. All right. So going on to TLT, TLT, same deal, right? If you're conservative, you were staying in cash. Aggressive, you were selling that 105 naked call. with a stop at 104.93. And TLT also, you would have on this one, TLT. So this one you would have sold it back here for 60 cents. Price did get stopped out for an $80 loss, and yeah, it's kind of shot straight up here. Okay, so going on. LQD, LQD again, trader trend was neutral. If you were conservative, you didn't do anything. And if you were aggressive, you sold the 109 naked call with a stop at 108.18. So LQD. All right, LQD, you would have got it for 30 cents and you would have taken a stop and lost 35 bucks on that one. So going on to EFA. EFA, the trader trend was bullish and hold. Now remember, again, we talked about this even you saw it in the write-up too. Unless you're very, very bullish or bearish, depending on what this is, you don't do the vertical, right? The vertical is like the hyper trend position, right? You could just sell the naked put and that's it. This with all the trading here and the conditional entries, that is only if you really, really were bullish and tight and you have strong, strong trend. So obviously the recommendation really wasn't even to do the trader trend, right? It's just stay up here. But if you had of, you would have got filled at, let's see, you would have got filled at 88 cents on the naked put, and that would have gotten stopped out on the 15th of March. Actually, we can go look at it. Let me read this through though. And then the bull call spread was a conditional entry at 69.85 with a target of 77.16 and a stop at 67.41. And so that one, like I said, it got filled. Let's go back to EFA. We'll check that. EFA. All right, so EFA, if you look back here, right, it got filled at the 69.50 put got filled at 88 cents. Um, it went down and got stopped out, pretty quick, pretty fast on the 15th of March for a $212 loss is where he got hit at. And the vertical got filled and then it got stopped on March 15th for a $158 loss too. So that one doubled up on the loss, and as the market just trended kind of straight down against us in pretty sharp move in early March. So going on to EWW, EWW, the trader trend was bullish hold here. The naked put was for the 54.78 um, March put, and the bull call spread was a conditional entry, 54.78 to 56.78. If EWW printed 55.35 or below with a conditional target of 57.41 and the stop at 53.42. And this one also got stopped out. Let's go look at the premiums we got for it and kind of see what happened. So we got EWW. All right, so EWW, it opened up at 58.57, right? So it opened 58.57, and you would have sold that that unit here for 25 cents, which you actually would have got back on the 25 cent, uh, the 25-cent one there. So that one actually didn't get stopped out. Let's see my notes here. And so that one you would have got back for 20 bucks. Now on March 13th, the uh, the bull call spread would have gotten filled and then stopped out, right? So if you look, 55.35 was where the conditional entry was. So it dropped down to 55.35 here, and then so then 53.42 was the actual stop, which it didn't actually get to. But if you had ran this thing all the way to the March expiration, you were down $111. But the short call closed worthless, right, on the short end of it. So you would have ended up long, um, just that call, and that would have been for $111 loss. Okay, so no sale on the 56.78s for under 15 cents, and that's just kind of the way that one played out. Now you could have converted it into some stock if you wanted to, you'd still be in the trade, um, but that's the way that one played out. So moving on to EWZ. right? EWZ, the trader trend was neutral, and so you would have sold if you were conservative, stayed in cash, aggressive, you're going to sell the March 30th call with a stop at 26.48. That one, EWZ. Right, so EWZ opened at 28.43, so you would have gotten 52-cent credit for it, and you would have got that back to $47, $47 profit as the units went out for 5 cents and never actually went up to 30 cents there. All right, so going on to GLD. Right, GLD was bullish or holding the trader trend. The March 173 naked put was the recommended put sale, and then if you were hyper bullish on that one, you would have actually got into the 173, 181 bull call spread when price printed 170.57 or below, with a conditional target at 180.179 and a stop at 169.43. Now this trade, let me go look at it. Let's go. All right, so price opened on this one at 171.20, right? So right over here, and and when price opened up on that. I'm sorry, it's back here. So when price opened up at 171.20, you would have got $3.30 for that short put, and and that one actually went out, right? Because price obviously never dropped down to get stopped. Uh, and so that one you would have got $330 back on February 23rd. When that, or I got filled, I'm sorry, got filled February 23rd, and you would have taken max profit on that one. Now uh, the actual bull call spread did get filled, right? And then price ran. Um, the It expired, right? Those contracts expired on the 17th here, and so at that point, you know, your short call would have gotten would have went out, and then the long call, you actually would have taken a small $73 loss against that $330 profit, just because of it just went to expiration without hitting target. Okay, so there's gold. Now silver, the trader trend was neutral again, conservative. You're staying in cash. If you're aggressive, you were selling the March 2050 naked call with a stop at 2047. Now this one, let's go to silver. All right, so silver opened back here at 2013, so you would have gotten 40 cents for that unit, and you would have closed them out in profit for 35 cents each, as it did not go to its stop. Right, so moving on. XME. So XME, the recommendation here was a March 54 naked put. And then if price dropped to 54.76 or below, you enter the 54.59 bull call spread with a target at 59.87 and a stop at 52.88. This one, um, let's go back to see how we did on here. XME. All right, so XME opened at 56.15 and you took in a 96-cent credit, which then got stopped out on March 10th. You can see the stop out down here. Um, so you took a $76 loss on that just because you had some definite time decay only a week out from expiration when the stop happened. And the on March 10th, the bull call spread did fill, right, but then unfortunately did get stopped at 52.88. As we see, price drops right down. And so that bull call spread would have taken another $127 loss there. Got stopped uh, on the 10th of March too, right? And so there you go on that one. And moving on to XOP. All right, XOP trader trend was neutral here as well. Conservative trader staying cash. If you were aggressive, you would have sold 139 naked call with a stop at 138.95. And so this one, we'll see how we did in XOP. ISXOP had a big drop as well after we already got filled. So that one would have been, if you take the recommendation, you would have got $2 of net credit, and you would have got stopped out on the 3rd of March for it went up for $192 loss as it popped up to 141. Okay, so going on to XLE. XLE was also neutral with recommendation for aggressive traders to sell the 87 naked call to stop at 86.44. Conservative traders just didn't do anything, right? And so XLE, see how we did there. All right, XLE, that one was it got let's see, okay, so we opened up and we opened up at 84.12, took in $1.71 on the premium, and it actually got stopped out in a small profit for a $23 profit on March 3rd. Okay, so moving on to DBA. DBA, their trader term recommendation was to sell the March 20 naked put, and if price dropped below 2016, to do the 2021 bull call spread with a target at 2057 and a stop uh, at 2003. And so with DBA, all right, so DBA opened at 2063, and you would have sold those units for 15 cents. Um, and that one, actually, there was, yeah, that one didn't actually, oh, actually, that one was open at 2068. Yeah, so you sold the naked put there. So yeah, that would have came down to obviously got stopped out for pretty much no loss. Actually, it was going to break even almost just because the uh, you actually gain some time decay through it. So it was pretty neutral on that. And then the actual bull call spread would have got filled on the 2nd of March, and um, and on that one, the it did get stopped as well for a $25 loss. All right, so the as DBA. All right, moving on to XBI. All right, XBI, the trader trend was bullish or hold, and the recommendation was to sell the 86 naked put, and if price dropped to 86.43 or below, to put on the 86.91 bull call spread with a target at 91.86 and a stop at 84.62. That one, let's see how XBI did. All right, so XBI opened at we go opened at 85.83, so you would have got a $2.66 credit on that short put, which then did get stopped out on the 21st of February, so soon after, and for a $74 loss. And then the bull call spread. Remember the bull call spread on this one, because it opened where it opened, which was right at 85, 83. You know, it opened, you were already kind of in the range here. Yeah, you would, usually give it a little bit of time to go up and kind of prove it. But if you had to jump in, the stops were pretty tight on that, and you would have got stopped out for just a $30 loss on that bull call spread. All right, so going on to VNQ. VNQ, the recommendation was sell the March 90 naked put, and if price went to 89.91 or below, you would have put on the 90.96 bull call spread with a stop at 87.78 and a take profit at 96.29. That one filled the 90 put. Fill. Let's go with VNQ. All right, so VNQ opened at 88.61 that day, and then you would have sold that 90 put for 245. And Uh, that one actually got stopped out as well. This price got to drop straight down on 21st February for a $105 loss. The bull call spread did fill and right by the stop, actually. So again, we've talked about not putting on these trades, so other than being hyper bullish, right? If you're right by your stop, this is the odds of getting stopped out are really high, and but it was like a $10 loss if you took that bull call spread. Okay, so going on to XHB. XHB, the recommendation here was to sell the 66 make it put with a conditional entry of the 66.73 bull call spread if price drops 66.31 or below, with a stop at 64.05 and a profit target of 73.11. So on XHB, so on XHB, price opened at 67.68, and you would have got a $1.36 credit, which then got stopped out on March 15th, right over here, and you would have taken a smaller loss, right, $79 loss, just because you got some premium there. And then the bull call spread did fill, and at 66.31, and then you got stopped out for a $210 loss on that one. Okay, so going into the indices, SPY, the trader trend was to sell the 404 make it put, and if price went to 404.28 or below, to put on the 404 426 bull put spread with a target of 426.50 and a stop at 396.87. So price opened right under 404, I believe. Let's go SPY. Oop, not soy. So yeah, price opened at 403.06. So you took it at $8.73 credit that then got stopped out on February 23rd for a $300 loss, 301 specifically, and then the bull call spread did get filled for another $320 loss. So that's SPY, and let's go to the Qs. Like I said, I told you guys a lot of stop outs on this trader trend as we were in the range. Trend trading doesn't work well in a range, right? So as we're learning here. All right, so on this one, the Qs were to sell the 294 make it put, and if price went 294.77 or below, to put on the 294 314 bull put spread with a target of 314.05 and a stop at 288.35. So on this one, detected QQQ. I'm sure we can guess, right? So on this guy, price actually opened at 297.26, and you would have taken in a $6.56 credit for the 294 put, that then got stopped out for $194 loss. And the spread did fill and then got stopped for a $600 loss on the Qs before it then obviously rallied through here, but got stopped out on the bottom. Actually hit the stop loss. Yeah, the stop loss was down at 288, right? And then finally, we got IWM. IWM, the recommendation was to sell the 188 naked put, and if price went to 188.57 or below, to put on the 188 200 bull call spread with a target 256 and a stop at 184.54. So IWM opened up at 190.75, and it filled for $3.31 credit, which then got stopped out on March 9th for $119 loss. And the vertical did fill and had a max loss at a stop out too of $325. So overall, grand total, again, we like to tally all these things up and we see exactly what we would have done if just selling the bull call spread, I mean, just selling the short unit or doing the vertical. Now, if you just had it done the short units, just one unit each as a benchmark, it was an $862 losing issue on the trader trend this time around. And if you had it done the verticals, it was another $1,600 loss. Again, to just recap on this, remember over time, guys, this is very mechanical, and we do recommend that. You read the market expectations and follow them. They've been very, very spot on. But again, if you do want to keep it mechanical, over time, these things do make money. And sometimes the hedges are really important to have. So, like I said, I recommend futures and back spreads are the best ways to do it. You can't short stock an IRA, so that's a different thing too if you're trading a retirement account. But going outside of that with the futures account to hedge overnight risk is a really good way to do it. And I'll make a video in the future on really how to put all this together. and make it to where it could be really a lot safer and more beneficial to run these things. Like I said, insurance is great, and sometimes when the market really trends hard one way, it goes against you. It's nice to have it, even though usually, we won't need it, but we're thankful when we do, right? So again, you guys, thanks so much. We'll see you on the next issue. Appreciate it. Bye bye.